markets move, headlines can get loud and noisy, and it can create a temptation to tinker with your portfolio. And I would say the reality is, though, the more frequently that you fiddle with your portfolio, the more likely you are to make emotional decisions that could work against you and not help you.
Most bad portfolio decisions feel smart in the moment. It's not until later that you realize the impact of that decision that it actually had on the overall portfolio.
Hello and welcome back to Retire Stronger, episode 45. And today I have with me my co-host and co-founder of Crown Advisors, Bill Kearney. Bill, say hello to everybody.
John, how you doing? Hello to everyone out there. Good to be with you today.
It is indeed another great day, another great episode. And I know today, Bill, we're going to talk about how often should I be fiddling with my portfolio? And Bill, I think you would agree. We hear this, or we get this question quite often in our discussions with our clients, with potential clients. And I would say probably one of the most common questions that we hear is, how often should I be making changes to my portfolio? And I think that what people are typically trying to ask when they ask this question is, should I be doing something right now? Depending on what right now means. As we sit here today, the markets are getting hit pretty hard based on headline news and things that are going on out there in the economy and in the world news that's coming out. And people typically sometimes will panic, or they'll be fearful of what they're seeing, what they're hearing, and they want to know, hey, should we make changes? Should we make adjustment? Should I go to cash to protect my assets? And I'll just say this, markets move, headlines can get loud and noisy, and it can create a temptation to tinker with your portfolio. And I would say the reality is, though, the more frequently that you fiddle with your portfolio, the more likely you are to make emotional decisions that could work against you and not help you. So again, today we're going to talk about this and give you our thoughts on it and kind of walk through some suggestions that we might have to help combat your temptation to make emotional decisions and changes to your portfolio over time. And, at the end of the day, I would say, Bill, that, it's better to be engaged versus being reactive, and having a plan in place, sticking with that plan, assuming the plan is the right plan for you. And there is, quality information, quality data backing up why you are on the path you're currently sitting in with regard to your investments makes a whole lot more sense than just flying by the seat of your pants. And the more you touch your portfolio emotionally, the more likely you are to hurt it. And I know you would agree with that. So, Bill, tell me, I'm curious, what are your thoughts here? Like, why investors feel the urge to tinker? Why do they do that?
It's a great question, John. And I think that a lot of people, I think it would be important to start with setting a definition of what types of accounts and what types of portfolios are we referring to here. So for example, let's say that you're a day trader. You have accounts that you use for day trading purposes. Obviously, with that type of account, you're going to have a lot more touch points, a lot more tinkering, if you want to call it that, or fiddling, because there's a purpose behind what you're doing from a day-to-day standpoint. If you have, let's say that you have a large retirement portfolio, but maybe you have a side account that you like to trade options in, or there's different types of stocks that you like to buy and sell and trade just to see how things work, right? I don't think there's anything wrong with either one of those options. So just to be clear, we're not saying that you can't tinker at all with your portfolio, but it's important to partition out the parts of your portfolio that should and can be tinkered with, and the other parts that need to have specific direction behind them, which is the bulk of your retirement portfolio, right? And so just wanted to give that as a backdrop. But I think everyone gets the urge to tinker, to fiddle with their portfolio from time to time. We all look at it, and simply put, simple things like market headlines can create urgency and fear for you to do something. And I will tell you that one of the best ways that can occur is by watching the financial shows on TV.
Exactly.
Their job is to create urgency and fear and doubt, and that can often lead you to make emotional decisions on where you should go. But in that vein, when you're watching those types of shows and you're looking at it, and you see the performance of certain stocks and how great they're doing, those recent winners, they feel like they're safe. They feel like, hey, I want to, jump on the tail of that dragon and see where this goes. But maybe that performance that you're seeing is at its end. Maybe it's time for that particular stock or that particular holding to have a pullback, and you're getting on at the wrong time. So, I think even daily balance checking for certain folks. So some people are fine with checking their balance daily, and that's not going to drive anything emotionally. But there are folks out there that, hey, if you check it daily, it creates an emotional reaction inside of you, positive or negative, about what's happening inside the portfolio. And I think what happens ultimately with all of that is we confuse activity and discipline, right? We think that because we're doing something, or because we're suggesting that we need to do something, that we're taking an action, that is a good step or a positive step inside of the portfolio. Oftentimes it's not, right? Oftentimes it's counteractive to what you're actually trying to achieve inside of here. And I think that everyone out there would look at it and say, in the moment that you're making a portfolio decision, it feels like the smartest move you could possibly make in that moment, right? But we would say most bad portfolio decisions feel smart in the moment. It's not until later that you realize the impact of that decision that it actually had on the overall portfolio.
Oh, yeah. I 100% agree. So what actually then deserves a portfolio change? Legitimate reasons to make an adjustment. I would say, and Bill, feel free to chime in at any point here, but I would say that a life change, like retiring, like if you are coming up on retirement or you are retiring, that is an excellent opportunity to take a really good look at your portfolio, determine if changes need to be made and adjustments need to happen to positively impact what your plan is going forward. For example, if you're retiring and you no longer have a paycheck coming in, you're going to rely on your portfolio as a supplement to your other income sources, such as Social Security or some type of pension. So, retirement would be a great life change reason to make an adjustment, for your income needs. Maybe you have a major health situation that's happened, or maybe you didn't retire. Maybe you changed jobs, and now it's time to look at making adjustments when you do a rollover, because now you have more opportunities and more options you can choose from within your portfolio that you did not have inside of a 401k plan at your previous job. Maybe you've gotten a significant raise and you have new tax strategies that you need to consider. Or maybe you're doing a Roth conversion, or you're now at a point during retirement where you're starting to have to take required minimum distributions. These are all good reasons why you would want to make a possible change or to tinker with your portfolio and make changes to that. Maybe you have made a decision that your risk capacity has changed and you don't want to be as risky in your portfolio. That would certainly be a great reason to make a change or tinker with your portfolio. Maybe you want to be more risky. It just depends. I would say also that an area, that when and why we make changes for our clients' portfolios, systematic rebalancing. We do rebalancing for most of our portfolios on a quarterly basis. And folks, this is not market time. I'm not talking about trying to time the market and trying to, play the trends that are out there and have big wins, hit big home runs here. I'm talking about systematic, rules-based type scenarios where you are rebalancing on a regular basis or on a specified time frame, just to get your portfolio back into a nice, orderly setup that you started with at the beginning of the quarter. And I would say anything you want to add there, feel free to jump in. But go ahead,
John. I would definitely say with systematic rebalancing is critical, and having a system behind why you're making changes is important. If you were to go back, just do a Google search for the top 10 stocks from 1995, right? Then do a search for the top 10 stocks in 2005. then do one for 2015, right? And you can do these sequences, you'll realize, wait a minute, the stocks all changed.
Yep.
So if you're still holding the same companies from 1995 today in a portfolio, maybe it's a stock portfolio, not necessarily index related, well, the performance of that is going to be dramatically different than it was in 1995 because those companies may not even exist any longer, or they were bought, or something to that effect. So there has to be some type of systematic rebalancing to look at the portfolio and have what we would almost call an investment box or a buy box into what should I be owning going forward? What should I remove from the portfolio? And so having a system to figure out how to make those decisions is important. That's an active step that you can take. That's active rebalancing that actually is healthy for the portfolio. It's very similar to at your home, doing the pruning and the trimming and the cleaning up of the yard, right? We don't just let it get overgrown with the same things. We come back and we clean it up and make it look nice and maybe add new plants, shrubs and trees and that types of things over time to enhance what the yard looks like. Same thing with the portfolio. You have to treat it the same way.
Oh, I agree. So in that kind of similar vein, like what are reasons that would not deserve changes to your portfolio? And the top ones that come to mind for me that I think drive a lot of the questions we get, drive a lot of the conversations we have is, election cycles, regardless of what your affiliation is or who you vote for. I would tell you that just because an individual gets elected at a significant, position like president of the United States, for example, and it's not the candidate you voted for, that is definitely not a reason to make changes to your portfolio.
But we get phone calls, don't we, John?
We do. We get them a lot. And I would say that that's definitely not a reason. How about this one? You had one bad quarter. The markets didn't perform well, or the investments you chose to put your money in that quarter didn't perform well. Well, it doesn't mean that you're owning bad investments. And so I would say that one bad quarter would definitely not be a reason why you would want to make a change. We mentioned this a little bit ago, news-driven fear or hype. You said it best. These news channels, their whole intent is to get you to watch their news channel. And they have to make salacious statements. They have to make things sound urgent. They have to make things sound, fearful sometimes to get your attention. But that's not a reason to make a change, or how many times have you heard this? My neighbor went to cash to avoid a market crash because he thinks a market crash is imminent. The market's too high. We have to make changes here. I don't trust what's going to happen. These are all things that would definitely not be a reason to make a change. Again, going back to why, life changes, significant changes in your income, your risk factor maybe changed. Those are reasons why you would want to make a change. So one of the things I think that we like to share with our clients is let's look at the impact that these changes that you're asking us to do or considering doing on your own. How is that going to impact your overall strategy? So basically what I'm saying here is that the cost of basically over managing your portfolio. What would you say to that? How would you address that with someone?
Well, there's a cost to every decision that you make, right? And this is a perfect example of it. Let's say that you have the ability to look into the future and you can tell when the 10 worst trading days in the market are going to be, but you don't know when the 10 best trading days are going to be. Well, you would have the power then to move your account out of the market. But the problem with moving your account or timing the market or attempting to time the market is you have to be right twice.
Yes.
You have to be right on the way out, right? And then you have to be right on the way back in. And the problem with that type of strategy is oftentimes the 10 worst days each year in the stock market are surrounded or very close to the 10 best trading days in the stock market.
Yep, they're clustered around each other. Absolutely.
And we did a podcast much earlier. I'd like to go back and find that particular episode, John, where we talked about this. And we did a study about, if you miss the 10 worst trading days, but you also miss the 10 best trading days over the last 10 years, your portfolio would be negative. I think it was double-digit negative per year for the last 10 years. So you would have cut out the 10 worst trading days, but you would have also missed the 10 best trading days because of your timing model. Doesn't really put you ahead. And emotionally, it's probably a complete roller coaster to be on. So there's that as a cost associated with this. So John, let me give you an example, just a conceptual example of market timing. And this is just illustrative, not a promise, but let's take an example where we have $100,000 invested. This is a broad stock market type portfolio. We're looking over the most recent 10-year period, and we're going to look at fully investing versus a timing strategy. So if I were to stay fully invested in the market over the most recent 10-year period, my average annual return would be somewhere around 9 to 10%. So after 10 years, that $100,000 value that I started with is going to be up to around somewhere between $235,000 to $260,000.
All right, so let me get this straight real quick. So I want to make sure I understand. So you're saying if you were to have averaged in that range of 9 to 10% over a 10-year period, whether it's the most recent or not, doesn't matter. But after 10 years, you said you would have with $100,000 invested, assuming you average that 9 to 10% around $235,000 to $260K, depending on what your actual return was, whether it was 9 or 10.
Correct.
Okay, got it. I'm with you.
Now, remember, I'm riding that roller coaster, right? I'm riding the positive days, the negative days, positive years, the negative years, all of it. I'm not making any changes to that particular portfolio. That's where I would end up. Not too bad. But that's difficult for people to do, especially if you're doing this yourself, right? So scenario 2 would be I have the magic wand that I mentioned earlier, and I can wave that magic wand and I can miss the 10 worst days of the market, only the 10 worst days. I still get all the good days, right? So this is the perfect timing fantasy. Now, I will tell you that we have been working for years on this particular timing fantasy, and we're almost to step 2. But we'll let you know if we make any more progress on that. In this example, the hypothetical annual return, if you could miss the 10 worst days, would be somewhere around 14 to 16% per year over this 10-year period. So here, my $100,000 would grow to somewhere between $390,000 to $440,000 over that period of time. So that's awesome, right? It's incredible, but it also assumes superhuman foresight, which again, we're working on it. We're not there quite yet. Yeah.
Yeah. And it's back to your point of having the foresight to know when to get out, but also, the foresight of knowing when to get back in, which is, well, no one's been able to do that yet, but go ahead.
Exactly. It would be incredible if you could do something like that. Now,
for sure.
What if I give you the third option, which is I can miss the 10 worst days, but I'm also going to miss the 10 best days. This is more reality for a timing model, right? This is more likely what's going to happen because, again, those best days and worst days tend to cluster around each other because you'll have a drop in the market and a snapback, a drop in the market and a snapback. That's commonly what happens with the market, right? It just overcorrects and then it snaps back to where it wants to go. In this instance, if I miss the 10 worst and the 10 best trading days, it drops that average annual return to around 4 to 5%. So now my ending value after 10 years is around $150,000 to $165,000.
Right. We haven't even doubled the money in a 10-year period there.
Haven't even doubled the money over that particular period of time. And remember, this doesn't account for the emotional toll that's being taken by doing it this way. You miss those 10 worst days, you feel great. Oh, I missed the 10 best trading days. I feel awful. I'm looking at my portfolio and it's just not doing what I want it to do. This is what happens a lot of times with most market timers. And it's why it's really not a strategy to lean on for the preponderance of your portfolio or really for any of it from that standpoint. So just a quick example to kind of illustrate that for the audience.
Great examples. And thank you for that.
Another part of this I think that's critical is people don't necessarily consider the tax consequences in their taxable accounts. So we're referring to non-qualified accounts, not your pre-tax IRA or a Roth, but your individual brokerage account. When you make trades in that account, you can generate capital gains. And depending on how long you held the positions in your account, those could be short or long-term capital gains, which are taxed differently.
Yes.
And that sort of cost can compound over the year as you continue to tinker with the account. So there's that whole part of it, just an actual dollars and cents cost, but maybe a little bit more abstract or hard to define is the emotional fatigue and the loss of confidence in the market. At some point, by doing this type of trading or doing this type of activity on the account and maybe not being successful with it, you're just going to throw your hands up and say, well, this doesn't make any sense. This isn't for me. I can't make this work. And that's an emotional toll that is pretty taxing on people as well. You're putting all of the pressure on yourself to be right every time by doing that. And so I think, my opinion is, I think portfolios fail more often from behavior than actually by how they're designed, right? It's more the emotional reaction to it. And we get it. I mean, it's a tough thing. Money and the markets and all of that, it creates this emotional tie, this emotional bond. And so we say we put our money into the market and we see how it's performing. And man, it's great when it's going up, but boy, it really hurts when it's going down. You have to create discipline in yourself to remove yourself from those emotional twists and turns, right? That emotional roller coaster, if you want to be a successful investor.
Yeah. I mean, there is an entire subset of our industry that focuses solely on behavioral investment strategies and the overall behavior of the investor. And I would tell you that industry doesn't exist just out of thin air. It exists, that side of our industry exists because investor behavior is a major roadblock to success for a lot of people. And it's a real thing, and there's so much that goes into it. We could do an entire podcast, probably an entire series of podcasts on investor behavior and why it's so important to not allow your emotions to take over when making decisions. It's why folks should hire, a financial planner to help them with balancing that emotional attachment to their money and create a plan that's proper, that's balanced, that has, kind of almost a rules-based approach, really, if you want to put it that way, to how decisions are made. Because, if you're just, again, using my term earlier, if you're just flying by the seat of your pants and you're letting emotions run the decisions that you make, you could do well, but it might be in spite of the fact that, that you don't have a solid plan in place to get you from point A to point B. And so, yeah, Bill, you nailed it. Emotions, behavior, all of that is probably more of a factor in how you're going to do and how you're going to perform long term than almost anything else that will, that you'll deal with. So Bill, how often should someone touch a portfolio? I know we've kind of hit on a little bit of this throughout the episode so far, but I would say, as a general framework, as a general idea, kind of a rule of thumb, we religiously stick to rebalancing on a quarterly basis for our portfolios that need changes and adjustments made. Now, does that mean we're not going to make changes or rebalance intra-quarter or at some other time throughout the year? No, it doesn't mean that at all. If fundamentals change, if major shifts in strategy need to be adjusted, then we'll make those changes. We'll make rebalances. We'll make reallocations where necessary. But that would have to be a major situation, a major happening in the economy that would drive that decision. Otherwise, we stick to a pretty rules-based, strategy of our rebalancing structure, and there's reasons for that, as we've already discussed. Doing planning reviews with clients, we typically do reviews with clients at the beginning of the year for an annual review, and then we do additional reviews in the November timeframe to prep us for the end of the year, especially dealing with tax situations. But, again, going back to life changes and major things that are happening with you, whether it's retirement or job changes or risk appetite, shifts for how you feel about the risk. Those are things that can dictate a change at any given time throughout the year, not just on a quarterly basis. But, I would say that ongoing monitoring always happens in our portfolios. We're always monitoring. But changes are not every day. You brought up day trading earlier. We don't day trade. That's not what we do. It's not what you should be doing if you have a long-term strategy. A long-term strategy does not include day trading. So anyway, I would say this. I tell people all the time, proper and good investment strategies are and can be very boring. And that's not a flaw. That's a feature. That's what you want. Boring, steady structure and long-term growth strategy is what you want out of your portfolio. Anything you would add to that?
I was just going to say, you're making it sound all pretty boring, but unfortunately, that's the best way to do the investing, is to kind of have a calm approach to it. When everyone else is out there losing their head, that's not the time for you to be losing your head, because you know how your portfolio is invested. This also ties into what we've talked about before with the bucket strategy. We have a bucketing type strategy. It's more of a visual for people to see where their money is located and why it's being invested the way it is. And the bucket strategy just has 3 buckets. It's now, soon, and later. And the now bucket is the always available, ever-present money. It's going to be safe and liquid, right? And then the soon bucket is the things we're going to need over the next 5 to 10 years. And that's going to be invested differently than the now bucket. And the later bucket is your longer term bucket. That's going to be divided up and invested differently than the previous 2 buckets. But that's a strategy that helps you figure out, okay, well, when the sky seems to be falling, how is this affecting my overall portfolio? What is the plan doing to account for this? And am I going to be okay? Well, you're going to know that going into it ahead of time. John, I wanted to ask you a question to see what your thoughts are on this. Rebalancing, this concept of rebalancing, maybe for people to understand a little bit more clearly. Does rebalancing always mean that we're changing holdings inside the portfolio? What do you mean by rebalancing?
Yeah, that's a great question. And it could mean that we possibly swap out a holding for something else. I would say that in that scenario, that is because there is a fundamental change in the underlying holdings of the portfolio. But typically, I think what you're asking and what you're wanting me to get to here is rebalancing basically means just resetting a portfolio back to its original structure, back to its original percentages of the holdings that we have allocated to a portfolio. So, and why would we do that? And what would cause that? Well, let's say you have 10 holdings in your portfolio, and a couple of the holdings have had a really strong quarter or a really strong year, and they have increased in value to where now your portfolio is no longer balanced as we originally set it up. So we would trim that imbalance off of those holdings and reallocate it back to the remainder of the portfolio to bring the portfolio back in line with its original structure. So that's what we mean when we talk about rebalancing. But to your point though, Bill, we could potentially, have a fundamental change in a specific holding or 2 or 3, and those holdings may get, moved out of the portfolio and something gets moved in to replace it. But again,
I'll give you an example. I'll give you an example of when this happened. Just in January, we went to our investment committee meeting at Crown, and I finally got John to agree to remove Enron and WorldCom from our portfolios. And we also were holding a company that was making horse and buggy whips. So we were able to remove those because they were just underperforming. And we decided to look at a new company called NVIDIA, right, John? Isn't that the decisions we made? That's how we did it, right?
It's so funny. Yeah, you tease and you joke. But seriously though, you're describing the process. We have investment committee meetings quarterly to determine if changes need to be made in portfolios and what those changes are. And there are many times over the past years where the changes were simply rebalancing of, back to the original intent and original structure of the portfolio, and no holdings were removed or replaced. But to your point, yeah, that's what happens. We go in, we look at it, we watch it, we monitor it daily, we monitor it monthly and quarterly. And as changes need to be made, we'll make those changes. But typically it's a rebalance back to the original structure. And that's what we're referring to when we talk about rebalancing.
Very good. Thanks for clearing that up.
Yeah. So folks, I think we're at the end of our time for today. If you're sitting out there wondering whether or not you should be tinkering and making changes to your portfolio, but you don't know what to do, give us a call, 704-469-0200, or find us on our website at crownadvisorgroup.com. You can also hit a button on there to schedule some time to chat with us or sit down with us if you have questions about your current portfolio. Don't feel like you have to go at this alone. There's help available. And if it's not us, find a trusted advisor out there that can help you navigate some of these emotional decisions that can have lasting impact on your overall portfolio. And if you found this episode helpful, please hit that like button or that subscribe button and forward it on to a family member, a friend, or a colleague. We would certainly appreciate that. And we appreciate you spending time with us today. I'm John Foard, and for Bill Kearney, we'll see you on the next episode. Have a great day, folks.